So, again, welcome everybody this evening to the next big short. Again, my name is Don Kaufman from TheoTrade. A few things we'll get covered right up front over here. Number one, risk disclosure. We're not financial advisors or a broker dealer. The reason, again, we always have tendency to throw this up right when we get off and rolling is I spent the previous 15 years of my career in, of course, the brokerage industry, which I'll talk about here momentarily. Next, we have a copyright disclaimer. This is ours. You cannot reproduce this without the express consent of TheoTrade and maybe the National Football League. All right. By the way, our address is on there too. This is a little bit about me. I saw my screen flashing over here, and I am going to fix that immediately. So this is a little bit about me. I'm co-founder, lead instructor here at TheoTrade. I've been trading for, well, about 19 years. I started my trading career back in the late 90s in Chicago. I'm going to make sure that this is not flashing throughout. I will fix this, okay? So there we go. So I started my trading career in the late 90s in Chicago. I didn't necessarily go out and do a business degree or anything. That was strange. I will fix this again as I saw a little bit of flashing over here. So bear with me as we get things off and rolling here. Technological issue. Right. Stop. And we shall restart that momentarily. All right. So as I was saying, started in the late 90s in Chicago. I came from a family of traders and was invited at a very early age, at 22, to work Chicago Board Options Exchange. Shortly thereafter, I met a couple of individuals at the Chicago Board Options Exchange. They invited me into what at the time was a startup brokerage firm. That brokerage firm was called thinkorswim. Thinkorswim eventually emerged into one of the leading stocks, options, futures platforms, and was acquired by TD Ameritrade. I resided there for the additional time of about 5 years before finally hanging it up at TD Ameritrade and helping educate their 7 million clients. A little background on me. In addition, you know, we've done the CNBC tour out there. I used to do that a number of times years ago. I'm not so much into it, but again, if you're going to be pitted against somebody on CNBC, that's the guy for me. By the way, no, that's not me, not Kevin. That's me, Don. A little bit about TheoTrade. We specialize in education for stocks, options, futures. We're founded by professional traders, educators. All of us have a minimum of 15 years of experience, several of us with many decades. We're here to help you mitigate the risks in the market. In fact, that's one of the primary things we're going to talk about tonight. I know everybody's here. I want to make money, make money, make money. We're going to talk about that. But risk mitigation is a huge portion of this evening's discussion. Well, of course, learning a skill set that'll last a lifetime. You know, the other thing I always like to bring up is who is TheoTrade. So many of you, hopefully, again, we fixed the flashing over there. Some people said, all right, so it's all good. We fixed it. So who is TheoTrade? Many of you may know me from either the, thinkorswim, TD Ameritrade days. If you don't, welcome. Okay. TheoTrade is not just myself, Don Kaufman. We have Doc Severson. If you guys have heard of Doc, who here has heard of Doc Severson? Stocks, options, technicals, Jeff Bierman. Jeff actually worked with me at thinkorswim and TD Ameritrade for 7 years. Jeff worked directly with me. He was also the former chief market technician for TD Ameritrade, which is a highly coveted position, given the fact that ultimately at, again, TD Ameritrade, they have 7 million clients. Now, I'm going to fix this flashing if it kills me over here, so bear with me here momentarily as I'm talking, walking, and figuring this out over here. We will fix this for sure. So hang on just a second. See if that doesn't necessarily help it. If it doesn't, I'm going to switch screens on you guys, and we'll just keep right on rolling. Anyway, so Jeff worked with me at TD Ameritrade. Then we have Steve Slim Miller, 43-year veteran, stocks, options, futures. Slim actually started at the same time the Chicago Board Options Exchange started. Then last, but definitely not least, Tony Rago. He's our intraday strategist specializing, of course, in NASDAQ futures. So we currently have 5 full-time instructors, including, of course, myself. Again, some with 43 years plus experience out there. So let's get jumping right into this evening. Okay, if it flashes, that's all right. I will freeze the screen. We will work through it. First thing I want to talk about, this is actually a slide that I use quite often, okay? And with that, and again, I'm going to work through here as we're going along. With that, this is a slide I use quite often about risks and success. I think too many people, they get into this business with this illusion, okay, that it's all about being right and so forth. And what it really comes down to in the marketplace, and again, listen, the buck stops here, right? I watched 7 million brokerage accounts. Like, you know, I've seen order flow. And one of the things you learn over the years is how you handle your risk is directly correlated to your success in the markets. Too much risk, you're going to panic. You're going to close positions continuously at the worst possible time. But people are always consistent with one thing. They're consistent with their panic. And yeah, it's a little Mac like throwing up. And since, you know, we call puking the trade over here. And I cannot stress this enough that, you know, we have what, just almost 1,000 people in the room this evening. And when we start discussing, hang on, I think I found the issue over here. We start discussing, you know, trading and so forth. One of the things I like to always focus on is I have a tendency to look at risk first. And it's primarily because of the experiences. You know, I worked at a brokerage firm when the market was collapsing in 2000, 2001, 2002. I worked, you know, and watched order flow and traded through 2008. And if you think about everything you've ever done in the marketplace, think about this for a second. Everything you've ever done in the marketplace, when did you close your positions? Okay. Think about that for a second. At the worst possible time. You know, people got stopped out. The stock ran against them. That's ultimately what goes on, okay? I mean, people panic at the worst possible times out there. So let's take it a bit further over here. It's going to come what we call get ready. It's coming. We're about to embark on what could be one of the most pivotal periods in our market's history. Prediction of the risk that we're going to talk about tonight, I believe, is relatively easy. Timing the onset of this risk is a relative impossibility. Now think about what I just stated in there and you realize, all right, everybody sees a lot of the risks, I think, that are prevalent in the marketplace, okay? We need to twist the risk in our favor. Now, that's, again, what does that mean? Tonight, we're going to present a strategy whereby we can harness the potential afforded to us by the current market environment. I'll explain what that environment is here. Specifically, I want to detail for how very little capital up front. So we want minimal exposure up front. We're going to try to go out. We're going to risk $1 to potentially make 10 with, again, very little upfront costs, very little transaction costs, okay? We don't want to extend ourselves too much. So in the next 45 minutes, you're going to see precisely the strategy, the plausible risks, and how you can place these trades. So ready? Let's get into it. All right. First of all, the volatility, or lack thereof, right? I mean, has anybody seen the market in the last couple of days? No, nobody's seen anything. Why? Because we haven't done anything. Volatility in the markets. Have you ever spent time looking at volatility in the markets, okay, and compared that, just think about logically, compared that with what you believed the risk to be, right? This, again, it's kind of a leading question, but it's a big one. First, what is volatility and what does it measure? Volatility most notably measures risk in the market, okay? So we're going to have just a brief discussion about volatility. So volatility is equivalent to risk. Option markets can be thought of as putting a price tag on risk. Now, I said the O word. Listen, tonight, later on, we're going to show you a strategy. That strategy will employ options. If you've never, ever traded an option in your life, breathe deeply. It's okay. Okay? We get it. You know, we can ramp you up from absolutely A to Z if you've never traded an option. Out of my own curiosity here, though, how many of you have traded an option in some way, shape, or form? Okay. And by the way, these are not rhetorical questions. Jump in. You could be watching this, a week from now, and you should still answer. You're like looking at YouTube over there, yelling at the YouTube. All right. All right. Fast them out. Okay. A couple of no's over there. It's fine. Beginner is good. All right. All right. Couple of many years. So the options markets put a price tag on risk. I mean, that's what options really do. They're trying to handicap what risk is in the future. Pricing in markets is determined via market participants. People say all kinds of things about options, but in the end, what prices an option? Bunch of market participants out there. Listen, if everybody in the world demands options, prices of the options go up. If everybody in the world selling options, prices go down. Ultimately, options pricing comes down to supply and demand. But when anybody says volatility, the word volatility is like this dirty word, okay? Volatility is just synonymous with risk. That's what it is. That market is volatile. What are you saying? Oh, that market's really risky. But the professional world came up with this softer, gentler phrase. They called it volatility. So there's two types of volatility. And I'm just going to give you a quick and brief, maybe dirty understanding of how volatility kind of works. Okay, so again, there's two types of volatility. We're really going to focus more on implied volatility tonight, but you have to know what historical volatility is. It's the annualized standard deviation of the past stock price movement. All right, that's a really not exciting definition. For those of you, if you want to know what historical volatility is, it's just a measurement, okay, of how fast the market's moving. It's stock price movement. That's it. Right? So if you look at a stock like Apple and it's, not moving around that much, and then you look at something like Tesla and Tesla's moving around a ton, historical volatility is higher in Tesla than it is in Apple. But then we have implied volatility. Okay? Now implied volatility, this is like this marquee definition, but forget about the marquee definition. You know what implied volatility is? It's telling you what the marketplace now is implying risk to be in the what? Future. Implied volatility. It's telling you now what risk is supposed to be a week from now, 2 weeks from now, 3 weeks from now. Okay? That's the important portion of that. So if you look at this, this is a distribution curve. All right? What does it do? Okay? Distribution curve. Well, let's say we have a stock and the stock is trading right smack at 100. Now, I've used this example for years, and that underlying has a volatility of 20%. Now, this volatility that we're talking about right here of 20%, that's the implied volatility. That's what options are putting a price tag on risk into the future. Okay? But what does that really mean? Like when people look at volatility, come on, how many people here have ever looked at the VIX? You look at the VIX all the time. You're like, what is the VIX? What is the VIX? Okay, the VIX, the VIX, the VIX, the VIX. It's the volatility index. The VIX right now is right around 10. Well, but this is a stock with volatility of 20. But again, what does that really mean? When the VIX is at 10, what does it really translate to? It translates to movement. It's how far, okay, the market is anticipating movement. So this volatility, of like 20%, it seems like very esoteric, but it really translates into stock price movement, or in the case of the VIX, S&P 500 movement. If you looked at the VIX right now, it's trading at 10. We'll actually have a slide here in a moment where we bring up the VIX. It's trading at 10. Well, the S&P 500 is a $2,500 product. It says within 1 year of time, we're supposed to move up about 10% or down about 10%. That's it. Okay? That's it. It literally, what does the VIX mean? It means the market volatility. It's actually a measurement of risk at any given point in time. Now, if you look at the marketplace, and the marketplace is at 2,500, in fact, I'll even sketch this out here for you. So let's say here we have a VIX, okay? And the VIX is 10, and then we have a marketplace trading all the way at 2,500, okay? Well, what's 10%? So it says the marketplace within 1 year of time is supposed to be able to move up 10%, okay, or down 10%. And it's supposed to do that within, again, 1 year. Now, let me blank this for just a second, all right? We'll erase all the drawings over here, go back to normal mode. if you take a look at this 68%, it's supposed to stay in that range about 68% of the time. Now again, that's just a quick rundown of volatility. Now why am I explaining this? Because the next slide, there's no fear or loathing on Wall Street. The degree of complacency in the markets, considering the myriad of tail risks, it's absolutely remarkable right now. Like, again, I've been in this business since the late 90s, never seen anything like this. But I have a couple of counterparts that I work with that have been in the business since the 1970s, have never seen anything like this. What you're looking at right now, this is a 3-year chart on the VIX itself. And you'll see volatility is doing nothing but decreasing as our risks and the myriad of risks are actually growing. And it's one of the things that I questioned earlier. I said, have you ever thought about, like, what do you think risk is right now in the marketplace? And then you look at the actual risk, which is here the VIX, and you're like, wait a second, those two, they almost don't make sense in my head right now. Let's state some of the issues. We've got a lot of issues with you people, right? I mean, let's look at some of the issues that are outstanding in today's marketplace. First of all, this is what we'll call the looming risks. FOMC and central bankers, interest rate policy. Is that one of the risks? Of course. Okay. Well, what's the issue with the interest rate policy? Okay. For the most part, the issue with the interest rate policy, well, where do you want to start over here? Are we raising rates? Are we lowering rates? Because it depends on what part of the world you're actually in. You know, we have something called the Bank of Japan. They're not necessarily ready to raise rates. Then we have the European Central Bank and Mario Draghi, who they have negative interest rates in portions of it, as does Japan. Central banks buying of corporate debt in ETFs, okay? Presidential administration, $11 trillion right now of negative yielding debt. $11 trillion of negative yielding debt, negative interest rate policy. Again, it's back to the Bank of Japan. Or if you look right now at the German bond, that's the German bonds, they're a negative rate. 2-year German bonds are negative. That means, think about what that means for a second. You, okay, ultimately pay to do what? Okay, to give them your money. You're giving them your money and you're paying to do it. You have to put negative interest rates in perspective. Chinese debt right now is 270% of GDP. That's a little scary. The Chinese banking system has grown 1,000% in 10 years. It's a little scary. There's 1.3 trillion in student debt, 42% delinquency, postponed or in default. Very few people see those statistics, okay? They say there's only 11% in delinquency, but it's a total of 42% that have actually postponed or delinquent or in default. There's still Brexit looming over here. We have currency devaluations. There's North Korea. And there's a big correction. These aren't looming risks. They're actually all current events. And this is, I'm not telling anybody anything they haven't actually seen before. But when you start to put those risks and this myriad of risks along with what's going inside, and by the way, I'm, you know, with all due respect, I'm not even getting into the fact that we're looking at natural disasters almost on a day-to-day basis right now. And again, these are all looming risks and current events that are going on. And then you realize this doesn't make sense. Like, it just doesn't make sense. And that's when we come into the suppression of risk. It's the Federal Market Open Committee, aka the Fed. Ironically, tomorrow is an FOMC meeting. Remember, the FOMC, Federal Market Open Committee. So Janet Yellen tomorrow will ultimately tell us something, okay? Central banks produce volatility suppression. Let me explain this. Thanks to the central bankers, banks, proprietary trading firms, hedge funds, anywhere in the world, they can borrow capital with near zero interest rates. And think about that again. If you're a hedge fund, if you're a trading firm, if you're a bank, what can you do? You can borrow money for next to nothing, okay? The world financial systems are bursting with cheap or free money. In some cases, negative interest rate policy will pay somebody to take your money. You take my money and I'll pay you to do so. in many circumstances, negative interest rate is forcing lending. And yes, it's all by ultimately design. Trillions are seeking returns. So here's, again, an interesting perspective. When I say trillions are seeking returns, that's no joke. The global financial systems are flush with free money, is causing asset managers and traders to seek returns anywhere and everywhere. Okay, I'll give you an example. Venezuela, all right, bonds. Venezuela has numerous occasions, okay, not actually paid their debt in the bonds. It's been in the court cases. They've defaulted on their bonds. Just recently, they had another bond offering. No sooner did the bond offering go out, by the way, they paid next to nothing on the interest rate. No sooner did the bond offering went out, and they're not paying it right now. And again, the glut of capital is smashing volatility as market participants will throw caution to the wind in search of returns. I know this is not that happy stuff, okay, but we're going somewhere with this. And that's what's important, is that this, again, there's a means to this, right? Governments are buying stocks. If you didn't or were not aware of this, the Swiss National Bank has gone so far as to print money in order to purchase stocks. So now we actually have what ultimately people like the Fed that are clearly going out there and they're purchasing the Swiss National Bank. By the way, the SNB stands for Swiss National Bank. Swiss National Bank. They own about 80 billion in U.S. stocks as of June of 2017, and a guesstimate of 20 billion or so in European stocks. They've bought roughly 17 billion worth of U.S. stocks so far this year. That's just through June. They bought 17 billion worth of stocks thus far this year, and they're printing capital to do that. They have no formula, absolutely no formula. They have stated that. They're just trying to manage their currency by buying U.S. stocks. They have about $10,000, that's in U.S. currency, $10,000 in U.S. stocks on their books for every man, woman, and child in Switzerland. In addition, the Bank of Japan owned about 71% of all shares in Japan-listed ETFs at the end of June of 2017. The reason it's June was the end of the quarter. It was the best time to actually pull the data. The BOJ, that's Bank of Japan ETF buying, now targeted around 6 trillion yen. That's $53 billion annually that they're going out there and actually buying their own ETFs. The NLI Research Institute has forecast that the Bank of Japan could own almost 3/4 of the free-floating shares, okay, of Fast Retailing Company. That is the most heavily weighted company on the Nikkei. Okay, and again, these statistics are astounding when actually put together. So the market's become irrational on free money. Money pouring into the financial system, it's inadvertently, okay, and it's almost like a bad side effect, suppressed volatility, but it's also suppressed price discovery. If you guys have never thought of what's price discovery, that's the market's functioning. I mean, what's price discovery? I don't know. What's Tesla really worth? What's Tesla really worth when somebody's actually printing capital at the Swiss National Bank to go out and buy Tesla stock? It's one of the holdings. If you're not aware, Swiss National Bank is one of the single largest holders of Apple stock right now. On a broader time frame, you need to seriously forget about, there's no charts and there's no technicals. There's no fundamental analysis. I know that makes for good discussion on CNBC and so forth, but there's no fundamentals. Volatility readings are totally deceased. Now, all of this, I know a lot of people look at this and they're like, great, you know, that's it. I'm done with this business, but this is all into opportunity. Suppression of risk presents one of the most incredible opportunities, okay, that we've seen. And again, I say we're going to embark on this turning point in the marketplace. And again, I cannot stress this enough, but do not look at this as like, you know, this is going to be brutal. You have to look at this for what it is. Suppression of risk presents opportunity. Risk is good. Recognize all these issues for what they really are, and that's your opportunity. You need a strategy whereby you will not substantiate inordinate risks, yet you want to position yourself for what eventually turns into an onslaught of volatility. Now, remember earlier when I said we don't know when the onslaught of volatility is coming. All you know is, come on, you see the risks out there? You think the VIX is going to stay at 10 forever? No, it's probably going to go down to 8 for a while, okay? But you have to be positioned, and you will not be able to position when it comes. It's either, you're in or you're out, and you're going to have to make some decisions, okay? Let's put it bluntly. We want to buy volatility. We want to buy volatility with both hands as we believe the future market risks are formidable. Even if you don't believe the risks are forthcoming, you still need to accept the relative dangers and mitigate your exposure accordingly. And I say that because some people are like, you know what, you're right. The Swiss bank is just going to keep printing capital and printing capital. Yeah, you have to realize something. They'll run out of things to buy. They've already done that in Europe. The European Central Bank and Mario Draghi, they have run out of bonds to buy. Japan has the exact same issue. They got nothing left to buy. When there's nothing left to buy and they own the entire float, what do you have? You have very few shares that are going to be available, which actually will increase volatility of the marketplace. If you have a 401k or an IRA, even if you don't believe risk is coming, you still need to mitigate exposure. And what that means is just reduce exposure. The risks are clear, and we can see the opportunity. Yet, how do you go about buying volatility? Like, what are we going to do? What are we going to do? Go out and buy volatility. You can buy volatility-based ETF products. It's common knowledge we can buy volatility products in today's marketplace. However, volatility-based products are riddled with failure. Have you looked at these volatility exchange-traded funds, ETFs? Let's take a look at two prominent volatility ETFs. This is where people always go to. They go, that guy told me to buy volatility. I'm telling you right now, we're going to show you the VXX. We're going to show you the UVXY. Have you seen what these things look like? When I say riddled with failure, I don't think people get it. Can't make this up. The VXX has lost 72% plus of its value. That's in just the last year. So we're clear, okay? Take a look. That is a 1 year. My mouse is on it. That's a 1 year chart. So you want to buy volatility? You're going to lose 72%, okay, of whatever you put in there. Literally, a year ago, you would have paid $154. It's now worth $40. They keep having to reverse split this product. That's the VXX. This is the lesser of the evils. The UVXY is in a death spiral. It's lost 94%. It's actually closer to 95% of its value in the past year. Like, what's the point of these products? If you actually read the prospectus in these products, it says, don't even hold this thing overnight because there's no chance if you hold it overnight, you're going to make money. Okay? It's, again, insane out there what people are not aware of. You're going to be flushing your money. Buying volatility ETFs is a fast way to lose money. You cannot succeed buying volatility outright. You can't go out and just say, I want to buy volatility. Why? Because the world is already there. They already see it. You think the entire professional trading arena doesn't see that this is going to be the biggest opportunity out there? Right? People talk about like 2008. Okay? The volatility here could be bigger, but you're going to have to be smarter than your competition. You don't have to be smarter than some of these firms out there, but you got to be smarter than the average person that's going to go out and buy a volatility ETF. And I apologize to those of you that have already done that, but it literally, I had to look hard for this, is flushing money down a toilet. That's ultimately what it comes down to. So positioning your portfolio for a big move. Let's kind of get down and dirty. How do you position yourself most effectively for the possibility of an extreme move? But see, it's a possibility, but you can't expose yourself to drastic risks. And you don't want to get cute. This is not about like, let's come up with a nice, cute strategy over here. You don't want to get cute. You want to do something that's clean because there are literally millions of dollars up for grabs. We're going to employ what we call a risk twist spread. Okay? Employ a ratio type option spread to an index and or equity product The index, by the way, if you don't know the term index, it means like something like the S&P 500, or you could do this in the NASDAQ, or an equity product. What's an equity? Well, something like an Apple, a Tesla, known as what we call this a risk twist spread. The idea of this is very, very straightforward. We want to achieve maximum reward for minimal upfront cost. The whole idea of the risk twist, it just screams, limit the exposure, maximize your potential. Why? Because we don't know when the onset of the risk comes into play. We don't know. And that's the relative truth of looking at this risk twist spread. This is the risk graph. It's huge potential, minimal risks. If you've never looked at a risk graph before, I'm going to take you through a little bit about it, okay? And again, when you take a look at this, all this risk graph is denoting, okay, is where markets, okay, happen to be, which are right up in this area. And what this risk graph is indicating is profit and loss if the market were to go down. Now, this market that I'm actually depicting in this shot happens to be none other than the spiders. Okay, it's the spiders. Now, you could use the SPX, you could use the spiders, you could use the Qs. The product you use is, in effect, incredibly important, okay? But what you're going to recognize, like, and if you look at this, there are very, very, very minimal risks, because right over here, and I'm kind of mousing around it. In fact, I'll even draw on the screen so that everybody sees precisely what we're looking at. Right in this neighborhood here, that's the zero line, okay? The market is actually trading right in this neighborhood here, okay? Right around the 250 level is where the spiders currently are. If the market rallies to the upside, the loss is so minimal that you can barely see it. I mean, we're talking about, again, minute capital exposure if we are wrong. If we're wrong and we stay flat, we're fine, okay? If we go up and continue to rally, we're fine. We're talking, again, it's a small premium to pay. If the market sells off big, you can see the risk graph, and that risk graph will explode. And so we're also very clear, how big is this trade? Well, I'm going to show you exactly that, but this trade is actually one contract, okay? This is one contract of what we call a risk twist spread. It's one contract of a risk twist spread, and it has this explosive. Now, granted, here we are at 250. If the market sold off and sold off big down to 220, I mean, you're up in the neighborhood of about $1,500, okay? But we all have to agree, is that a fairly substantial move? Yes, okay? The timing and the onset of this move, though, you don't know when it's going to come. So this can be an incredibly valid trade if you just want to reduce risk of a 401k. You may have mutual funds. I mean, people could have their liquid net worth tied up. You may have an IRA, or, okay, maybe you don't have a lot of risk on right now. Maybe you don't have a lot of risk on right now. So what might you want with the spread? You may have a smaller account, and you just want huge potential in the event of a major sell-off. And that's what this can also afford you the ability to be able to do. Again, it's all about having huge potential with minimal risks. It's about buying the volatility, but paying next to nothing for it up front. The characteristics of a risk twist spread. First and foremost, this thing has increased value when exposed to heavy volatility. So if the market really starts to sell off, the risk twist spread will explode in value. And I want to make this very, very clear and concise. This is the trade down below. We don't have no problem, like, let's show you what a trade looks like. You're like, it's one contract, it's one unit. It's a 1 by 3 by 1. Okay, I'll come back down to the trade here momentarily. So it increased value when the market sells off. It explodes in price in your favor when there's heavy volatility. There's significant profit potential in any downside market move. Loses very, very minimal capital if the markets rally. Okay, loses minimal capital if the markets continue to drift sideways, need only be placed a few times a year. Now, that's also critical. And I'm going to tell you right now, this is a trade that is only placed quarterly. This is a trade that is only placed quarterly. It only has to be placed a few times a year. As I said, you don't know when the risk is going to come. You're going to wake up one morning and the S&P is going to be down huge. You're like, what happened? I don't know. Pick something. The FOMC did something. You know, missiles are firing over your head. You just do not know. It's the perfect risk, or the perfect spread, I should say, to reduce risk of a stock portfolio. If you have a 401k or an IRA, it's also an excellent tool for those seeking large returns on a big market event. Now, in terms of the structure itself, just going to take you through it a little bit here, because what the trade really amounts to is we are selling, okay, options to finance buying options, okay, and then turning around and selling options again. The risk twist spread, it's an ingenious little way to get yourself long volatility, but the upfront cost, okay, in this particular case is $1.17 debit. So one contract would cost you just over $100. Now people, oh, what about commissions? Okay, yeah, we got that covered too. We have negotiated commission structures with a number of major broker dealers. Okay, so it's $117 to kind of let you sleep at night, and that's really what we want to implement right now in terms of a trade. You see how prevalent the risks are. Building the risk twist spread. Please don't let options intimidate you. Again, the spread below is being done for $1.17 debit. But this spread, you know, I always use this analogy, is akin to a massive chainsaw. And that analogy comes from just a really simple thing. If you're going to go out and you're going to build a house, okay, you're going to go out and build a house, you could use a handsaw to be able to build the house. You're going to cut, like, you know, if you're going to cut 2x4s, you can cut it with a handsaw. It's probably going to take you like 500 years to build a house, but you'll eventually get it done using a handsaw. But a strategy like this is, again, it's relative. It's an analogy with, you know, using a power saw or a chainsaw. I mean, those things are going to get you like a power saw. You're going to be cutting through 2x4s like they're butter over there. This spread, it's the quickest, fastest, safest way to get where you want to go. But you are going to have to do a little bit of work in terms of options if you've never traded them before. Used correctly, this can be an incredibly effective trade. Used incorrectly, of course, you're going to cut off a couple of fingers. And again, I list the trade on here so that people can go and they can check it out for themselves and play around with the risk graph. But fear not the risk twist spread. You know, you may not know options or have limited experience in placing option trades. We can show you the how, when, why, where to place risk twist spreads in a matter of a few hours. What we do here at TheoTrade is we create detailed recipes for every strategy, including the risk twist spreads. You know, you wouldn't go out and you wouldn't bake a cake without a recipe. So why trade without, you know, some type of a recipe? And that's exactly what we do. We build recipes in trading. I mean, criteria. It's what we at TheoTrade do. TheoTrade, it's about answering the what ifs. I mean, that's trading in general. I don't know, what if the stock goes up? What if the stock goes down? What might be a good stock or ETF candidate for a risk twist spread? Think about that. The stock to put this on, it's huge. Okay, do it before earnings. Okay, you could chop off a couple of fingers. ETF candidates, right? So if you think about like different ETF candidates out there, you know, we got the spiders, we have the Qs, we have the IWM. Which is the right one? What's the correct option cycle? So when you start looking at this, you saw me do, you know, in terms of an option cycle, you saw me do a December trade. Why December? How much capital do you commit into these trades? Capital is going to be absolutely critical in here. What strike price options do I sell? How many? What do I buy? How many? Okay, you saw that trade was a 1x3x1. So putting this trade together initially, initially when you put the trade together, that's what criteria is about. All right, we have the answer to all those trade-related questions. What's the right probability for my trade? How many option contracts do I trade for my account size? Like, for example, you may have $50,000 account that you want to reduce risk in. We'll show you exactly how many option contracts to trade. When do I close my spread? Okay, when do you close the risk twist spread is, without unequivocation, the most critical aspect of the risk-to-risk spread. What if the stock sells off big? What's the correct return for this particular strategy? All of these factors, okay, we got the answers to. We have the answers to all your trade-related questions because that's what a recipe is. It's definitive criteria. It's checklists. Each strategy and each unique variable that you're going to encounter. Again, as I said, it's the how, when, why, at what price. It's just the beginning of the variables you're going to face while buying a risk-to-risk spread. You know, the secret, it's all in the sauce. You know, and again, people always, I could read about these spreads anywhere, and you could do this. Think again, the following strategy and corresponding criteria. It's the utmost attention to detail. We literally have now spent years fine-tuning this specific trade. In the risk-to-risk spread, we have literally spent years in fine-tuning the criteria. When we approach the section on criteria, you follow steps to be able to build a trade. And if you want to be able to build a risk-to-risk spread, we're doing a class on it, okay? It's Saturday, September 23rd. That is this Saturday. The class will probably run about 3 to 3.5 hours. So it's scheduled from 9 a.m. to 12 p.m. Central Time. I will be the instructor. The class is archived immediately and available indefinitely to you. So it's an on-demand class after we do it live. By the way, yes, I am doing the class live, okay? We'll be live with you for 3.5 hours. We archive that class instantaneously, and you can access it anytime. Along with the class, there's an entry and exit checklist. It's available to you. Actually, before the class even starts, will allow you to download, okay, a PDF file with all the entry and exit criteria. It's the actual checklist. In addition to that, by the way, the whole class, it's $197, okay? It's nothing to learn that one strategy. And you recognize that that strategy will help you reduce risk of a 401k or an IRA, or give you a wonderful shot if you've got a smaller account. In addition, we recognize that a lot of you may not have the options knowledge coming into this. So as added bonuses, we have ultimately what? Options 101. Now listen, a lot of you guys have probably been through our Options 101. You know, we offered it, okay, as a class, pretty easy to sign up for, but then we have Options 201. We have Options 301, which is known as the Volatility Essentials, okay? We've now recently added Options 401, what to expect in the market. This is fairly advanced, using expected move and probability. And then last, but definitely not least, we're adding an entire additional class. It's called the Guide to Get Short and Collecting Income, okay? I think that this is probably the nicest addition we've ever done and the nicest bonus we've ever put in terms of a package together. The Guide to Getting Short and Collecting Income, that was a $200 class. That one's available to you. If you sign up tonight, you can watch all of these tonight. These are currently archived. When I say archived, they're available on demand. You can watch it just like you would stream Netflix. You can download all the PowerPoints for them, okay? The entire package, it's $197, okay? This is not some like introductory offer. It's $197, all right? The address for this is TheoTrade.com/twist, okay? And we'll put that into down below over here. We'll actually put the link in the chat if you need it. So let's put that in there. And it's again, TheoTrade.com/twist. Now, a few additional items here, and then I'll answer some questions, okay? TheoTrade.com/twist. This is the curriculum, all right, for the class. You're going to learn to construct the risk-twist spreads. You're going to build your own risk-twist spread, okay, with detailed step-by-step entry and exit criteria. By the way, listen, there's, 1,000+ people on tonight, and after going through the class, I never want you to believe that, you're on your own. It's $197. You're on your own. I don't care whether it's, a $5 class or a $500 class. For $197, you can email us. You can say, did I put this thing together right the first time through? Did I put this, trade together? that takes us, 2 minutes to look at. We have no problem doing that whatsoever. It's myself, it's Doc, it's Tony, okay? It's Jeff, it's Slim. I mean, we have enough instructors that we don't care if we even get 1,000 emails. It's fine. So we'll teach you to build this, with step-by-step by criteria. But if you have questions, ask them. Hedge your portfolio from any pending market turmoil. So one of the things that it talks about in this risk twist class is how to use the spread to reduce risk of a 401k or an IRA. Read the market risk like never before. It's going to give you insights, okay, to volatility beyond anything you've seen anywhere, okay? The truth is, really, when I look at this, the only thing we see is risk. Learn how to profit from the coming onslaught of volatility. We just don't know when the risk comes. The volatility, all right, is again, what is it? How can you profit from changes in market volatility? Well, that's what the risk twist really is. Discover how to create trades based on movement in market volatility and not purely direction of the markets. Learn why implied volatility is and what market instruments you can use to take advantage of changes in volatility. I mean, you're really going to get an in-depth understanding, of course, of implied volatility. Predominantly, that'll be in the bonus class in 401. Trades can be done in retirement accounts, minimal options experience, okay, with smaller accounts looking for large upside potential. So you could do this in really relatively any account, okay? So that's a little bit about the class itself. Again, the thing's $197. I'll bring up the site here in a moment. We say that, or you can have access to every class that we have ever done and access to every class we will do for the entire next year, okay? We always offer this, and it's TheoTrade.com/twist. I'll take you through it. What is $997? So we offer a class, which is $197, okay? Or we offer every class that we've ever done and every class that we're going to do for the entire coming year. These are some of the classes that we have already done. You could stream any of these, okay? Signing up for TheoTrade, this is not about when we built TheoTrade, there's a lot of firms out there, they charge for indicators. Then they charge, for this service. Then they charge for a chat room. Then they charge for this and they charge for that. We do everything at $997 for an entire year. It's $1,000 for an entire year. But instead of just giving you access to everything we do, we also give you access to everything we've done previously. The only way you get this is, yes, you do have to sign up for the full year membership. And again, it's not only everything that you're going to get for the next year, it's everything previous that we've done since the beginning of time of TheoTrade. These are just a couple of the classes. Guide to Selling High Probability Spreads, okay? This is the Ratio Butterfly class. I just did that one quite recently. Intraday Strategies and Setups if you're an intraday trader, okay? That's for intraday traders. That's people that want to trade, S&P futures, NASDAQ futures, surviving the extreme volatility, okay? Sell Premium and Manage Risk, a Covered Calls class, Consistency in Trading class, okay? We have the weekly options course, a Butterfly's Guide, okay? Pairs Trading, Technical Analysis 101, okay? There's a Tetrapod course, an RSI Unleashed, Plan or Get Slaughtered. I love the name of that class. Vertical Spread Probabilities with Technical Analysis, Small Options. It goes on and on. Some of these are Doc Severson's class. Some of these are Jeff Bierman. Some of them are mine. Some of them are Tony Rago's. There are a ton of classes that we offer, okay? And everything is included in TheoTrade. So I'll actually bring this up over here so you can take a look. Again, I'll throw the address up there so everybody can see it. It's TheoTrade.com/twist. It says we are here right now. Go ahead, chat in with them. If you have questions, that's what we're here for. It's just support at TheoTrade.com. Also, the support at TheoTrade.com, that goes to everybody. It's me, it's Jeff, okay? It's Tony, it's Doc. So feel free to email us anytime. Our phone number is listed on here. This is, again, if you just want to go to the next big short class, fantastic. It's $197. Check us out. You will see why these classes are worthwhile. You start watching, watch some of the bonuses tonight. If you've never seen the Options 101, it's a 5-part series, okay? Then we have a bonus number 2 over here, okay? Bonus number 2, Options 201 It's pretty intense. That's a 4-part series over there. Then we have Options 301, Volatility Expected Moves. Then we actually just take it to the extreme in Options 401. That's like starting to get to graduate level. Then there's an entire another class, a guide to getting short and collecting income. That's for people that look at the market and they go, I don't think I want to buy anything. I think I want to short some stocks. We'll even show you how to get short. We show you how to get short inside of a retirement account. Again, I spent 15 years in the brokerage industry, okay, so by all means, that is what we will offer. In addition, okay, if you have a TD Ameritrade account, we will give you a discounted commission rate. I cannot mention the discounted commission rate on any live broadcast. You are free to chat in. If you want to know the discount, you can chat in. We can, a one-on-one basis, ultimately take you through what that discount is. And I promise you this, I spent better part of 15 years working there. Our commission discount will put it against anything in the industry because nobody gets these kind of rates out there. We push them to the absolute limit. And if you don't have a TD Ameritrade account, we'll give you a link, okay, to get a TD Ameritrade account. If you don't want to be with TD Ameritrade, I don't care. We have other brokerage firms that we now deal with, okay? It's TD Ameritrade, though, that I want you guys to recognize something. They're the ones who keep the prices of our classes down. And people look, it's $197. How can you guys do this? Okay? Because the brokerage firms are actually chipping in. We have marketing relationships with them, and it makes it viable for us to offer classes for example, $197. Now, okay, in addition to it, and I will answer some questions here in just a moment, this is what we call total Theo. You're like, what costs $1,000? This is what costs $1,000, all right? It's everything that we do, and I'm going to explain about everything that we do. Like, what do we do here at TheoTrade on a day-to-day basis? The average day at TheoTrade, we stream live, okay, into a video player for about 5 hours. So each and every day, we will stream live for about 5 hours. Now, every single day, we're not just yapping at you what the market's going to do. Every single day, we have daily coaching sessions. All right. Today, actually, Jeff Bierman did a coaching session in terms of technical analysis. Okay. It's about 5 hours a day. It's not just myself. It's myself, Jeff, Doc, Slim, Tony. Okay. We all get a turn. That's what 5 hours is. And we're always adding new instructors here. Everybody's got a minimum of 15 years. We do live trades with people. Okay. We even email trades out to you. Again, that's what we do for the $1,000. If you have studies or scans, when I say studies, we use a couple of studies that we built. That's chart stuff, right? We use a couple of studies that we built. We have scans. We give them to you. Okay? We give them to everybody. Nobody should have to pay anything additional. It's $1,000. That's it. That's all we offer. Again, we email out trades. We give you email support. Anybody can get email support. I don't care. Email us, support@theotrade.com. You got questions? Email us. Okay? There's people that aren't even members that email us. But for the most part, okay, we want you to know that we're not just, the fly-by-night, like here's a class and then we'll sell you another class and sell you another class. All right? You want to be part of something, you want to learn this business, everything that we've done, okay, everything that we've done is in those archives. I mean, just this past summer, we did a Greek week. We had an entire week dedicated to understanding option Greeks. That's in there, okay? I mean, again, there are a ton of classes that we've already done. These are all the classes that we currently have in the archive. In fact, if you're interested in seeing the archive, here, I'll take you in, and I'll actually show you exactly what an archive looks like. So this is a TheoTrade chat room, okay? This is the TheoTrade chat room. The archives are located right here. You go into the class archive when you're a member of Total Theo, and you just start scrolling through. Pick a class, any class, but you're like, Don, there's so much stuff. I'm totally overwhelmed. Good. You have an entire year to look at this stuff. But we also have a little button called Start Here. I think we realize it's overwhelming. Start here. Options 101, all the different parts, calendar spreads, order execution. That teaches you. There's a class to teach you how to save money when you send off orders. Again, I worked in the brokerage industry for 15 years. We understand order execution, stocks, options, crash course in option Greeks, getting your risks under wraps, what products to watch and why, okay? All of this is where you start. say, hey, listen, it's not going to kill you. It's a little bit to go through. Let me answer some questions over here. A little bit to go through, but worth every portion of that time to go through. So as I said, I want to answer a couple of questions, and I apologize for the flashing over here. So by the way, somebody was asking about the brokerage accounts. We do have a specific code. Nobody calls TD Ameritrade and says, I want that TheoTrade discount. We will give you the directions after enrolling, okay? We will give you the exact and explicit directions on how to get the TD Ameritrade discount. You do not have to open up a new account. This is applicable. This is applicable if you have a current account. I don't care if you have 5 accounts with TD Ameritrade, or maybe you have an account with Charles Schwab and you want to move it to TD Ameritrade. Again, TD Ameritrade is not the only brokerage firm. Okay, for those of you that are Canadians, we have some suggestions as well, because it's much more expensive to trade if you're from Canada. Mark had a question here. Is this a trial subscription? It's not. This is not a trial. You have unlimited access to the on-demand recording of this class and its bonuses. It's a one-time fee of $197. Okay, if you sign up for the class, it's a one-time fee of $197. Okay, if you sign up for Total Theo, it's a fee of $997. You're like, well, what happens after a year? After a year, we'll email you and say, you want to do it again? Okay, and you know what? Right now, 87% of people that sign up for TheoTrade for a year sign up for an additional year. 87%. Okay, again, I let the clientele kind of speak for themselves here. All right, another question came in. Alex said, I can never get my head wrapped around options. Am I going to be able to follow along the class? So yeah, the bonuses that we're offering, which are 101, 201, 301, and 401, that's everything that you're going to need to get ramped up. In fact, each of those ramp up kind of courses, the 101, 201, and 301, and 401, I put those classes together in essence to ramp people up precisely the way that, well, we want to. And again, how many people that are joining us this evening have actually taken like the 101? Okay. By the way, Singapore, we got you taken care of. If you're in Singapore, we got your back over there. True story. I opened the office there in Singapore. Started that process back in 2008. So very, very familiar. If you were from Singapore, we got you covered over here. So, Alex, again, getting you ramped up, it's no problem. I mean, that's part of why we offer those bonuses with this is we realize that. All right. By the way, somebody needed help navigating. If you need help navigating thinkorswim, here, you want a fun one? Right over here where it says TheoTrade tutorials. If you sign up for this, look, this is all the tutorials of the stuff that really matters on thinkorswim. I did the tutorials. This is not like thinkorswim. I don't like those cheesy kind of scrub tutorials, so I put my own tutorials together for thinkorswim. A lot of the technology at that place, okay, it's playing it. A lot of the technology at that place, I had a lot to do with much of the technology, so I'm going to give you a very different look at a lot of the thinkorswim tools. So again, I put together some demos specifically for you on there, so no problem. Anyway, Susan had a quick question. Can this class help me reduce risk of my 401k and IRA? And Susan, that is expressly the intent. My initial intent of this entire class was let's reduce risk. But then as I'm putting it together, I'm like, wait a second. Somebody might not want to reduce risk. Somebody might just say, hey, let's just take a shot and hope one day that the market tanks. I got no problem with that. I'm all about that, okay? I don't mind telling you, I have short positions in the market. I have risk twist spreads on right now. And I do that because I just can't time that risk. Like there's just no way to time like when the risk comes. But if you're looking to reduce exposure, like you think about this, somebody in here is going to have a $250,000 IRA. They're like, nah, I'll just take my chances in the market. Please don't. Okay. I like beg people, just don't take your chances. It's not worth it. Somebody named Vlad. I'll take this one. Vladimir. I don't have that much time to trade. I work full-time. Will I be able to do this? So this particular course, the risk twist spread, is really you're only trading these a handful of times a year, okay? So this will have no issue whatsoever if you're working full-time. I mean, there's people working 65 hours a week. You got no problem whatsoever placing this type of a trade. You could use a good till canceled order if you need to. That means the trade will automatically execute for you when it hits a certain profit point. But quite frankly, I don't think you're going to even need to do that. It's really easy to place these trades in terms of time. You know, this is going to take a couple of minutes on a weekend to maybe price it, fire it off on a Monday. If you are a total Theo member, that's if you pay the $1,000, we email you quarterly to put these trades on. We will email you, we will show you the trade that I have on, and we will continue to show you when to close it and when to push it on for the next, you know, expiration out there. Matthew had a question. He said, I can't get approved for options because I'm a newbie. This is actually of critical importance. If you're brand new to this, okay, TD Ameritrade will accept our options 101, 201, 301, and 401 as experience. They accept what we've built here as experience. We'll actually walk you guys through. If you have any problem getting approved for options, we will walk you through that process, okay? You will not have an issue getting approved. Now, again, there's a number of brokerage firms that we will work with on this front. Do not worry about that, okay? Next one looks like from Marcia. I like this. I'm not sure this is a question. It's more of a comment. I have a 6-figure retirement account and need to be able to sleep at night. All right, that works for me. You could do this inside of an IRA. So it says retirement account. I assume it's an IRA. It could be a 401k, but you could do this inside of an IRA. And yeah, it's designed, of course, to be able to reduce risk. Okay. So, by the way, there was a question that came in and said, to protect a $250,000 portfolio, okay, how many of these will I need? I get into that specifically in the class, and it'll tell you exactly how many what we call units. How many units of an RTS spread do you need to reduce risk? And I actually go in and I break it down on a 10,000 by 10,000 basis. So meaning if every $10,000, okay, I'll actually show you exactly how many units of the trade that you need, okay? It's pretty easy, okay? By the way, we do some stuff with a number of brokerage firms out there, but again, I have strong feelings in the brokerage front of who we work with and who we don't. So, all right. By the way, we will show you specifically what any of the margin requirements are going to be, okay, and how to avoid risk in these trades. So, again, you could protect both a stock portfolio and or an options portfolio. You could even protect a mutual fund or a 401k. There's, again, no limitation to what you can do in terms of risk mitigation with this particular strategy. Another question was coming up about, let me show this on the main screen over here, but another question was coming up about the TheoTrade membership. So in the TheoTrade, this mentorship here, what we call Total Theo, again, it's every class that we've ever done, and it includes every class that we're going to do for the next year, okay? We do an average of about right now, we say a class a month, but quite frankly, we're doing 2 to 3 classes every single month because we have some classes that are on technical analysis. Like next month, we already have a class scheduled. So I'm going to do a class this weekend, right? Obviously, I'm going to do a class this weekend. It's the next big short class. Doc Severson is doing a class in the beginning of October. Tony Rago is actually going to do a class in October. And Jeff Bierman already has a class in the schedule in October. We have 3 classes already booked into October. And I think a lot of people will say like, I'll just buy every class. You're going to buy every class. You're going to end up spending more than $997 just on the 3 classes. It's worth it. And we make it worth your while. Check this out, theotrade.com/twist. Again, theotrade.com/twist. You can email us at any time, support@theotrade.com. Okay, never hesitate to email us. And our phone number is on there, 800-256-8888. 8876. By the way, if you're not up for like calling us, we're here. You can click right down here, put your name, put your email. You can actually initiate a chat with us immediately. Like if you want to get a hold of us right here, right now, okay, we're here, we're waiting, it's fine. Feel free to chat in here. I will stick around answering a couple of more questions, but I want to thank everybody for joining us tonight for the next big short, and I do hope to see you in the class, of course, this Saturday, 9 a.m. to about 12 noon Central Time, probably run a little bit over. Thanks, everybody, for joining us this evening.